Hello everyone, welcome back to International Financial Management. In our previous lecture, we examined the Mexican tequila crisis of 1994 and the Asian financial crisis of 1997. Today, we will understand the Impossible Trinity, a framework that brings together and explains many of the patterns we observed across the crisis. And then we will move on to Eurozone crisis. Let's begin. Now, let me step back across all the crises discussed so far, the Mexican, Asian, because the patterns are strikingly consistent. There is one thing, that is fixed exchange rate vulnerability. Every crisis involved a fixed or a semi-fixed exchange rate that attracted capital, creating false sense of security, and it prevented automatic adjustment, and this actually eventually broke into crisis. Mexican peso peg or the Asia's dollar peg is an example. Second thing is that there was high short term external debt. In every case, countries accumulated large volumes of short term foreign currency debt they could not service when conditions changed. Mexico's Teso bonds or Asian corporate dollar loans or Greek sovereign bonds. The third was there was fast track capital opening and crony capitalism. Rapid capital inflows into economies with weak governance consistently flowed into unproductive, politically connected activities, real estate bubbles, too much spending, connected lending, creating hidden vulnerabilities that only emerged in the time of burst. The lesson is consistent across all crises. The composition of capital flows matter as much as the volume. Fast, speculative, politically directed capital is dangerous. Productive, well-governed, long-term investment builds resilience. And now, with the three crises behind us, let me revisit the Impossible Trinity with fresh eyes. The Impossible Trinity or the Mundell-Fleming trilemma states that any country can achieve at most two of these three objectives simultaneously, never all three. Now, what are they? Fixed exchange rate. It provides currency stability, lower transaction cost, and second, free capital movement where the capital flows freely across borders, and third, independent monetary policy that sets domestic interest rates for domestic needs. You must choose two and sacrifice one. Every country, every currency regime is defined by which one it sacrifices. Let me walk through each combinations with real world examples and you will immediately recognize them from our lectures. Fixed exchange rate plus free capital movement. Now, what you have sacrificed here? You have sacrificed independent monetary policy. Now, if a country has a fixed exchange rate and allows capital to move freely across borders, then its interest rate cannot be set independently according to domestic needs. They must remain broadly aligned with interest rates in the country to which the currency is pegged. For example, suppose a country pegs its currency to the US dollar, and if the interest rate in US is 10%, but the country lowers its own interest rate to 5% to stimulate its domestic economy, then investors will move their money out of that country and into the US to earn the higher returns. As investors convert the domestic country into dollars and take their money out, the domestic currency comes under downward pressure. To maintain the fixed exchange rate, the central bank must use its foreign exchange reserves to buy back its own currency. If this continues, the country can quickly lose reserves and may eventually be forced to abandon the peg. Therefore, under the fixed exchange rate with free capital mobility, interest rates are often determined not by domestic economic conditions, but by the need to defend the exchange rate. Real world example is the Eurozone. Fixed rates among members, free capital movement within the zone. The price, that is the monetary policy, is set by European Central Bank for all members simultaneously. Greece and Germany have the same interest rate regardless of their different economic condition. This is precisely why Greece could not use monetary policy to stimulate its collapsing economy during the Eurozone crisis. Next comes your fixed exchange rate plus independent monetary policy. Now, when you have these two, then you have to sacrifice free capital movement. If you want exchange rate stability and your own interest rate, you must impose capital controls, preventing investors from arbitraging between your domestic interest rate and the rate implied by the peg or to the country to which your currency is pegged. Real world example, China. China has historically maintained and managed exchange rate that sets its own interest rate through the People's Bank of China. The price, capital controls, you cannot freely wire unlimited renminbi out of China. India follows similar logic, maintaining managed capital flows rather than full capital account convertibility, a choice validated by India's resilience during the 1997 Asian crisis and the 2010 Eurozone turmoil. Next comes free capital movement plus independent monetary policy. Now, what you have to sacrifice here? You have to sacrifice fixed exchange rate. The third combination chosen by most large developed economies is to allow free capital movement, maintain independent monetary policy and let the exchange rate float. Real world example is the United States. The Federal Reserve sets rates for domestic economic management. Capital moves freely in and out. The dollar floats, its value changes daily with market forces. Exchange rate volatility is the price of monetary independence and open market. Now, which combination is best? The honest answer is it depends on your economy's size, institutional quality, development stage and specific vulnerabilities. There is no universally right choice. Understanding which trade-off you are making and managing its risk is the art of international financial management. Now, we will study a crisis that struck the heart of the developed world, the most ambitious monetary union in human history, that is the Eurozone. Let us begin. The ECB, European Central Bank, was managing rates for the entire zone. One size fits all, but in the crisis it fitted nobody. To understand the Eurozone crisis, you first need to understand what the euro promised and what that promise actually created in practice. When the euro launched in 1999, 16 very different nations, that is Germany, France, Greece, Spain, Portugal, Ireland and others, agreed to share a single currency. No more exchange rate risk between them. One monetary policy for all. The ECB was managing rates for the entire zone. The immediate benefit was dramatic. Weaker economies like Greece and Portugal suddenly gained access to the euro's credibility and with it to historically lower interest rate that previously only Germany could access. Before the euro, Greece had paid high interest rate to borrow internationally. Investors demanded a premium for currency risk and default risk of Greece. After the euro, Greek bonds were priced almost identically to German bonds. Think about that for a moment. Greece, with its history of fiscal problems and currency devaluation, was now borrowing at nearly the same rate as Germany. There was no embedded country risk or default risk in the borrowing. What did Southern European governments and business do with this sudden access to cheap credit? They borrowed massively. Capital flooded to South Eurozone from Germany and France. So, it moved from Germany and France into Spain, Greece, Portugal and Ireland. But this is the critical point. This capital did not flow into productive export building investments. It flowed into consumption, real estate and government spending. A borrowed prosperity was created, and the question always with borrowed prosperity is, what happens when the bill becomes due? Member nations benefited from the strength and credibility of the euro. They enjoyed lower interest rates and greater access to investment capital. Capital was abundant in stronger economies such as Germany and France, and these countries lent at a lower interest rate to more capital scarce economy in the southern Europe. As a result, large amount of capital flowed into these countries. As money flows into a country, it increased liquidity. Businesses borrowed more, households spent more, and demands for goods, services and labor increased. Now, what was the result? The result was that wages and prices rose rapidly across southern Europe, consistently above the European average. And because the exchange rate was fixed, they were all using the euro. As demand for labor increased and wages began to rise, the production cost also increased. This led to inflation, made their goods progressively less competent relative to Germany. Over time, domestic goods became more expensive compared to the goods produced in any other countries. As a result, export became less competitive for these economies because foreign buyers could often find similar products more cheaply elsewhere. But here is the structural trap. Inside the Eurozone, a country in trouble has none of the standard crisis adjustment tools. First of all, it cannot devalue its currency. It does not have one. The euro belongs to all 19 members. It cannot cut interest rate because monetary policy is set by only one institution, that is European Central Bank for the entire zone. It cannot print money to manage its debts. Again, only the ECB controls money supply. The Eurozone crisis is fundamentally about a structural trap, and understanding this trap is the intellectual core of today's lecture. When countries joined euro, they agreed to the Maastricht criteria, that were the fiscal rules requiring government deficit below 3% of GDP and debt below 60% of GDP. They were very sensible rules, but there was a flaw. What was the flaw? Because there was no enforcement mechanisms. Countries that violated the criteria faced no real penalties, and many did violate them without any consequence. So, southern European countries borrowed freely, deficits rose and debts accumulated. Several Eurozone governments borrowed heavily. However, after global financial crisis, economic growth slowed down sharply. Businesses earned less, people spent less, unemployment increased, and therefore government collected less tax revenues. At the same time, government had to spend more on unemployment benefit, social support and economic stimulus. As a result, budget deficits increased and government debt kept rising, and it could only continue as long as northern lenders of Europe kept lending to the southern part. Once the lender understood the risk, they started demanding higher interest rates on new government borrowing. This made refinancing even more expensive and pushed some countries into a debt crisis. Greece was hit especially hard because its economy depended heavily on sectors such as tourism and shipping. These are highly sensitive sectors to the changes in business cycle. During downturns, fewer tourists travel and global trade slows, reducing shipping activity. Now, it was a global downturn which affected the tourism and the shipping activity. As these sectors weakened, Greece's income and tax revenue fell sharply, making its debt problem even more worse. Moreover, Greece could no longer rely on currency depreciation to keep tourism competitive, because before adopting the euro, the Greek dechma could weaken over time, making Greece a cheaper destination for foreign tourists. But after the euro replaced dechma, Greece was tied to a much stronger and more stable currency. As wages and prices rose in Greece, tourism became more expensive relative to other destinations. Let me now connect the setup of the first specific cause of the crisis, that is, capital flow imbalances and inflation. When southern European countries joined the euro, their interest rates fell sharply towards German levels. Cheap borrowing triggered a flood of capital from north, that is Germany and France, to the south. But this capital did not go into factories and export industries. They went into real estate, public sector wages and consumption. When the global financial crisis of 2008 hit, originating in US subprime mortgages, it triggered a severe global recession, and that recession exposed every weakness the boom years had been concealing. Tax revenue collapsed, government spending on unemployment and social protection rose automatically, fiscal deficit exploded. Now, here is what makes Eurozone's sovereign debt uniquely dangerous. When the US has a debt problem, it has options. It controls the dollars, can manage inflation, and in extreme can print. Investors accept lower rates on US debt because outright default risk is very low. A Eurozone member country has no such options. Greece cannot print euros. The ECB is not obligated to buy Greek bonds. So, when investors started doubting Greece's ability to repay, they demanded a very high interest rates. Now, look at the chart on your screen. The spread between Greek and German bond yields, which had been near zero before the crisis, exploded after 2009. At the peak, Greece was paying over 30 percentage points more than Germany. This is not a risk premium. This is the market saying we expect default. And now the banking sector became strangled. European banks, German, French, Dutch banks have been heavily lending to southern European governments and private sectors during the boom. Their balance sheets were loaded with Greek bonds, Spanish mortgages and Irish bank loans. Bank balances sheets came under stress. When sovereign debt came under stress, bank balance sheet came under stress. Banks stopped lending, the credit froze, economies contracted further, tax revenue fell further, deficit widened further, sovereign stress deepened. The sovereign bank doom loop, each side makes the other worse, and became the defining dynamic of Eurozone crisis. The third cause is financial imbalances, and this ties the picture together. With the Eurozone, a massive structural divide had opened between the North and the South. Germany ran persistent current account surpluses, exporting more than it imported, accumulating savings and lending those savings to South. Southern members ran persistent current account deficits, importing more than they exported and financing the gap with northern borrowing. In a country with its own currency, this imbalance self-corrects over time. The currency depreciates, exports become competitive again, the deficit narrows. But inside a currency union, no such automatic correction exists. This imbalances accumulated year after year, masked by cheap credit. Germany kept lending, Greece kept borrowing. When lending stopped, the full scale of accumulated imbalances appeared at once, and countries had to face the entire correction in one go, with no exchange rate tool to ease the pain. So, Europe had to respond, and the response operated on 4 levels, and I want to take each one separately because they each represent a fundamentally different kind of intervention. Let us start with the first, which is the structural reform. Now, I want to be very careful here because students often confuse structural reforms with austerity measures. They are not the same thing. Austerity is like cutting spendings, but structural reforms is changing how economy actually works. Think about it this way: if you have a car that is broken, austerity is reducing how much fuel you put in. Structural reform is fixing the engine. Now, these are two very different interventions. What did structural reform mean concretely for Greece, Portugal and Ireland? It meant making labour markets more flexible so that business could hire workers without facing mountains of bureaucratic restrictions and young people could actually enter the workforce. It meant dismantling regulatory barriers, red tapeism that prevented new businesses from starting up, sometimes requiring dozens of permits and months of waiting for things that just took a few days elsewhere in Europe. It meant improving tax collection, because here is the fact that often surprises students. Greece had significant structural tax compliance problem. Large portions of the economy were operating in the informal sector, off the books, paying little or no taxes. The government was spending as if it had the tax revenues of Germany, but collecting far less. And finally, it meant reforming unsustainable pension schemes, because in several of these countries the ratio of the retirees to active workers had reached levels that simply could not be sustained. The political resistance was ferocious. Pensioners took to streets, union called strikes, government fell, and understandably slow, there were real cuts to real income of real people. But here is the thing: by 2015 and 2016, as these reforms began taking effect, you started seeing something very remarkable. Productivity improvements and genuine exports growth in the countries like Portugal and Ireland. The engine was slowly and painfully beginning to work again. The second post-crisis measure is one of the most intellectually interesting institutional innovations of the entire crisis period, and this is the banking union. To understand why it was needed, you need to understand the problem it was designed to solve, and that problem has a name: the sovereign bank doom loop. Here is how the loop worked. European banks, German banks, French banks, Italian banks were holding enormous quantities of their own government bonds. This seemed sensible. Government bonds are supposedly the safest assets, but it created a dangerous circular dependency. When government debt came under stress, as it did in Greece, Ireland and Portugal, bank balance sheets came under stress because these banks had a lot of Greek bonds, Irish bonds, Portuguese bonds that now have become worthless. When bank balance sheets weakens, bank stops lending. When bank stops lending, the economy contracts. When the economy contracts, tax revenue fall. When tax revenues fall, government deficits widened. When government deficits widened, then government debt came under further stress. Now we can go back to the beginning, round and round, each turn making both the sovereign and the bank were simultaneously a doom loop and nobody could find the exit. The solution was elegant in its logic. Take banking supervision entirely out of the hands of national government and move it to the European level. The banking union had three pillars. Now, the European Central Bank directly supervises all major Eurozone banks, not the national regulators. It is ESB. The single resolution mechanisms, which means that when a bank fails, it is resolved at European level according to European rules, not national rules. This means a failing Irish bank does not automatically become the Irish government's problem. Next is common deposit insurance, protecting depositors across the zone with a common fund, preventing the panic of the depositors in weaker economies, moving all their money to German banks at the first sight of trouble. The third measure was the European Union and IMF response. Greece revealed its true deficit figure in 2010. International investors refused to lend. Greece had bond repayments coming due within weeks. There was no money to pay them. Sovereign default by the developed European country within the Eurozone appeared to be only days away. The European Union, through the European Commission and the newly created European Financial Stability Facility, committed the largest share of emergency lending. Greece alone eventually received packages totaling over 240 billion euros, the single largest sovereign bailout in history at that point. Ireland received 67.5 billion euros and Portugal received 78 billion euros. During the crisis, bond yields were rising sharply. This usually happens when investors sell bond and bond prices fall. Higher bond yields mean that the government has to offer higher interest rate to borrow new money. European central banks acted as an ultimate last line of defense. It purchased government bonds in the secondary market whenever necessary to prevent bond yields from rising sharply. Most dramatically, in July 2012, when ECB President Mario Draghi declared that the ECB would do whatever it takes to preserve the euro, that single statement immediately calmed financial market. Investors understood that the ECB's balance sheet was effectively unlimited and that it stood behind every Eurozone sovereign. As a result, speculative attacks stopped almost overnight. The lesson? In the financial crisis, credibility backstop matters as much as actual money, sometimes more. And now we come to the fourth and the most controversial post-crisis measure, which is the one that generated the most heated debate in the economics in the decades, that is bailout and austerity measures. In Greece, public sector wages were cut by 30 to 40%. Pensions that were the primary income for millions of elderly Greeks were cut multiple times. The pension system was restructured so that future retirees would receive significantly less than the current retirees had been promised. The healthcare system was cut. public employment was slashed and simultaneously taxes was raised. VAT went up, income taxes went up, property taxes were introduced. In Ireland, government spending was cut by nearly 25% between 2008 and 2013. Now, there is a case for austerity and there is a case against austerity. Let us first understand the case for austerity measures. The argument goes like this: Greece was spending far beyond its means. Years of fiscal irresponsibility had produced debt at 180% of GDP. Investors had lost confidence. Nobody would lend to Greece. To get investors lending again, Greece had to demonstrate fiscal credibility, that it was serious about getting its finance in order. You cannot demonstrate fiscal credibility while running a deficit of 12% of GDP. Therefore, you must cut dramatically and visibly to restore market confidence and regain market access. No austerity means no credibility, and no credibility means no lending, and low lending can lead to collapse. Now, let us give you a case which goes against the austerity measures and which was also made by some of the most eminent economists in the world. It states that when an economy is already in deep recession, cutting government spending is not just painful, it is counterproductive. Every euro of government spending cuts reduces economic demand by more than €1. The fiscal multiplier works in reverse. The economy contracts faster, tax revenues collapse, the deficit actually widens as the denominator, which is GDP, shrinks. You are tightening the noose around the patient who is already suffocating. Here is the lesson I want you to take from this. Bailouts prevent financial collapse, austerity restores fiscal credibility, but neither guarantee good economic outcomes. The Eurozone managed to prevent a complete collapse of the financial system, but it did not prevent a humanitarian economic crisis of the first order. Both things are simultaneously true, and any honest assessment of a Eurozone response must hold both in mind. But this Eurozone crisis was not just Greece. Ireland shows us completely different pathway to the same destination, and it is a pathway that every financial manager needs to understand. Ireland had been one of the Europe's fast growing economies through 1990s to 2000, celebrated internationally, apparently a model of successful development. But beneath the success, the domestic property bubble was inflating dangerously. Irish house prices were rising at extraordinary rates. Banks were lending freely to property developers and home owners, and Ireland's 6 main banks had concentrated their loan books almost entirely in the real estate. That means they were lending in the real estate projects only. So, Ireland's 6 main banks had concentrated most of their lending in the real estate sector. The government budget had also become heavily dependent on tax revenues from property transactions and capital gains. When the property market collapsed, banks suffered an estimated loss of around €100 billion because developers and homeowners defaulted on their loan. The Irish government promised that if Irish banks, including Irish private banks, could not repay their depositors and creditors, the government itself would step in and pay. But Irish banks had huge losses from the collapse of the property market. Investors realized that government might not be able to absorb this enormous banking loss. As a result, investors concluded that the Irish government itself could become unable to repay its own debt, and hence investors' confidence eroded. Borrowing cost increased and Ireland found it increasingly difficult to borrow in international market. Ireland was now in the same position as Greece, locked out of capital markets. I mean, having no access to the international capital markets, with bill becoming due and no way to repay them. Then the IMF, the European Commission and the ESB, they assembled for a rescue package. 67.5 billion euros for a country of 4.5 million people. This was an enormous sum which equivalents to approximately 40% of annual GDP. Now, every Irish taxpayer would directly or indirectly be paying for this bailout for decades. The psychological impact was devastating. As this bailout was implemented, unemployment exploded from pre-crisis level of approximately 4%. Irish unemployment rose above 14% by 2011 and even higher in some regions. This was not just statistics, this meant millions of Irish households were missing income. There were delayed mortgages and families were under stress. More critically, Irish youth unemployment reached nearly 35%. For young people entering the job market, prospects had evaporated. The response? Massive emigration. Hundreds of thousands of young Irish citizens left the country to Australia, China and United States. Anywhere offering opportunity, Ireland experienced a reversal of immigration flows it had not seen in decades. The final impact was a deep recession. Irish GDP contracted by approximately 9% between 2008 and 2010, one of the sharpest contractions in the developed world economic history. When you combine this with the austerity measures, public sector wage cuts, pension reductions, government spending slashed, the human cost was profound. The geography changes, the currency changes, the name changes, but the story is always the same. What is it? Borrowed prosperity, accumulated vulnerabilities and then sudden collapse. The Impossible Trinity reminds us that every country must choose its trade-off. There is no free lunch in international finance, but understanding your trade-offs and building the buffers to manage them. It separates economies that face crisis or overcome crisis from those that are defined by them. Now, in our next lecture, we will move to purchasing power parity and interest rate parity. Now, these are the theoretical foundations of exchange rate determinations. With today's context, those theories will come alive in a very meaningful way. Thank you, and I look forward to seeing you in the next lecture.